Okay, let's unpack this. I once knew this really incredibly successful tech guy, made a fortune.
Oh, yeah.
Yeah, designed some early Wi-Fi tech like in his 20s, sold multiple companies, seriously brilliant mind.
Wow.
But his relationship with money, it was, well, totally bizarre. He'd carry this like huge wad of $100 bills, always flashing it.
Huh. Okay.
Then, totally out of the blue, he'd do something impulsive, hand a few grand to a hotel worker, say, go put it all on black in Vegas.
Seriously.
Seriously. Technical genius, right. But the financial behavior just made, well, zero sense. And here's where it gets really interesting.
Okay.
That contrast, the brilliance here, the recklessness there, it really gets to the heart of what we're talking about today.
Which is?
When it comes to our financial lives, the psychology of money is just so much more powerful than the raw numbers, you know?
That story perfectly highlights something we often miss, doesn't it? We think finance is all logic. Spreadsheets, data.
Right, algorithms.
Exactly. But the truth is, our feelings, our pasts, our biases, these invisible things, they're constantly pulling the strings on our money decisions, often without us even noticing.
Totally. So in this deep dive, we're going to explore these surprising ways our minds, our histories, they shape the choices we make, often subconsciously. We want to get at the why behind our financial behavior and maybe figure out how to navigate those psychological currents a bit better.
And our guide for this is Morgan Housel's book, The Psychology of Money. It's fantastic.
It really is full of these short, sharp stories that just nail these often overlooked soft skills of finance.
Yeah. And for you, the listener, think of this as maybe a shortcut to understanding these really critical psychological ideas.
Moments, hopefully.
Exactly. Those moments where you connect the dots for your own financial life and maybe the wider world without getting bogged down in, jargon or tons of data.
All right, let's dive in. The first big piece here is just how much our personal history influences us. Subtly, often.
It's huge.
Yeah, our own experiences totally shape how we see money, risk, reward, everything. Think about John F. Kennedy during his campaign, right? His lack of firsthand experience with the Great Depression, it actually came up.
That's a great example because it highlights perspective, right? Kennedy himself admitted his family actually got richer during the Depression.
Yeah, he talked about hiring extra staff just to give people jobs.
So his understanding was intellectual. Harvard educated, sure, but not lived. How could someone like that, who never faced that kind of devastation, truly get the deep financial anxieties of someone who lived through it?
Exactly. Their whole relationship with money is just built on different foundations.
Someone who sailed through a crisis versus someone who barely survived it. Totally different views on security, on risk.
And it's not just those huge defining events. Think about the economy when you were, say, in your teens and early 20s. Those formative years, they leave a real mark.
Oh, absolutely. And it's quite specific, too. Someone coming of age in say, the 1970s, they probably saw a booming stock market.
Right.
That could easily make you optimistic about stocks for life. But contrast that with someone growing up in the 1950s. The market, inflation adjusted, basically went nowhere during their formative years.
So they might be way more cautious, maybe even skeptical about stocks.
Understandably. Or think about inflation. Someone who lived through the high inflation of the 60s and 70s, they have a gut reaction to rising prices that's completely different from someone who's only known low inflation.
It's kind of wild when you stop and think. Two people, maybe just 10 years apart in age, could have fundamentally different financial worldviews just because of when they grew up.
Yeah.
So for you listening, maybe pause and think. How did your own upbringing, those big economic moments you lived through, how did they shape your money mindset? What core beliefs do you have that might trace back to that?
Yeah, that's a really good exercise. And building on that foundation of personal history, the next thing is this sort of blurry line between control, luck, and risk. It's so important to remember. Every financial decision, no matter how weird it looks from the outside, makes sense to the person making it in that moment. Their story, their experiences led them there.
That really clicked for me with the lottery ticket example in the book. It's mind-blowing statistics.
Yeah.
Americans spend more on lottery tickets than on movies, video games, music, sports tickets combined.
Wow. And who buys most of them?
Lower-income households, disproportionately, which on the surface seems totally irrational, right? People struggling to cover a $400 emergency are spending maybe that much or more on these tiny odds.
But then you connect it to their lived experience.
Exactly.
For someone with limited ways to get ahead economically, The lottery might feel like one of the only shots, however tiny, at a really big life change, a big break.
So maybe not rational in a spreadsheet sense, but understandable in their context, in the story they're living.
Precisely. And then there's the whole luck and risk thing. It's humbling, really.
Yeah, we like to think we're fully in control, but random good luck, bad luck. They play these huge, often underestimated roles, like Bill Gates, obviously brilliant, driven. But the luck of going to Lakeside School, one of the only high schools in the world with a computer in 1968.
The odds are insane.
Right. Out of hundreds of millions of kids worldwide, maybe 300 went to that school.
It just shows how opportunity can multiply talent. Think of all the other smart kids back then who just didn't have that access.
For every Bill Gates, there's maybe a hypothetical Ken Evans just as smart but didn't get that lucky break.
Recognizing that luck factor forces you to be more nuanced about success, doesn't it? Yours and others. It's rarely just skill or just being deserving.
Which leads to a really critical point. It's dangerous to learn only from the extremes, the billionaires or the massive failures.
Because luck and risk play such an outsized role in those outlier stories.
Right. The lessons you try to pull from them might just not apply to, well, normal financial life.
Exactly. The more extreme the outcome, the less likely the specific lesson is relevant to you. Look for broader patterns, common themes across many experiences. That's usually much more useful. And when you look at failures, remember, failure can be a lousy teacher if you don't factor in risk. Sometimes good decisions still lead to bad outcomes because of stuff you couldn't control.
So you need resilience.
That's why structuring your finances to withstand setbacks, to have that resilience, it's just so incredibly important.
Okay, so personal history, luck, risk.
Yeah.
Got it. Now let's talk about this idea of the moving goalpost and how hard it is to know when enough is actually enough.
Oh, this is a big one. It's human nature, right? Your expectations just tend to grow along with your results.
Yeah, you make more, you want more.
Exactly. So if your definition of success keeps shifting upwards as you achieve more, you end up on this endless treadmill, always chasing more, never feeling like you have enough.
Happiness is just results minus expectations, kind of.
That's a great way to put it. You have to define your enough before comparing yourself to others moves the goalpost on you.
And social comparison just pours fuel on that fire.
Constantly.
The book uses that baseball rookie example, making $500,000 a year objectively rich.
Absolutely.
But if he's next to Mike Trout making, what, hundreds of millions,
Yeah.
suddenly he feels broke by comparison.
Yeah.
It's all relative. And that constant looking upwards can just poison your sense of well-being.
It's unsustainable, that comparison game. There's always someone with more. The trick is to consciously define your enough separate from what everyone else seems to have. And this ties directly into the idea that some things are just never worth risking, no matter the potential gain.
That Rajat Gupta story really drove that home for me. The former Goldman board member, insider trading conviction.
Here's a guy who had achieved enormous success, wealth, prestige.
Everything.
Yet the temptation for even more led him to risk it all. And he lost everything. Reputation, freedom.
The potential upside, even millions, was just nothing compared to the irreversible damage.
Exactly, just hammers home. Identify your non-negotiables, your integrity, relationships, peace of mind. No amount of money is worth risking those core things.
Okay, shifting gears slightly, let's talk about something more positive. Compounding. We hear the word, but really getting its power, especially the role of time.
Yes, it's transformative, but time is the absolute key ingredient. We get so focused on chasing high returns.
Thinking that's the secret sauce?
Right. But the reality, consistent, good enough returns, sustained over a long time, that's what unlocks compounding's magic. Warren Buffett is the classic example.
Incredible investor, no doubt.
Phenomenal skill. But the real reason for his staggering wealth isn't just the returns. It's that he's been doing it consistently for, what, 3/4 of a century? Starting super young?
It's mind-boggling. The book has that calculation. If Buffett started in his 30s and retired in his 60s, like most people,
His net worth would be, what, around 12 million?
something like that. Still great, obviously, but 99.9% less than his actual wealth. It just shows his superpower is longevity, time.
And it's not just about the return percentage itself. Think about Jim Simons at Renaissance Technologies. Higher average returns than Buffett over certain periods, for sure.
Yeah, much higher.
But Buffett's been at it for so much longer. The overall wealth difference is astronomical. Just shows that sticking around, surviving the ups and downs, is as critical as picking winners.
Like Jesse Livermore, the old trader. Made fortunes, lost fortunes, couldn't stick around.
Exactly. Lacked the staying power, couldn't manage the long-term risk. Cautionary tale.
So the takeaway isn't just chase huge returns. It's aim for pretty good returns you can actually stick with for the long haul.
Survive the bumps. Survive. That's when compounding really gets the time it needs to work.
Which leads perfectly to the next bit, planning with room for error, margin of safety.
Absolutely essential, because the only certainty in finance is uncertainty, right?
Right. The book stresses this. The most vital part of any plan is planning for things not going according to plan. That's the margin of safety.
Think of it as building a buffer. It's not about being timid or avoiding risk. It's about increasing your odds of long-term success at a given risk level.
Yeah.
Because you can absorb the unexpected stuff.
Mm-hmm.
The book calls it having a barbelled personality, optimistic about the long-term future.
But paranoid about short-term setbacks?
Exactly, like aggressively saving for retirement long-term, but also keeping a solid emergency fund in cash for right now. That's a barbelled approach.
That barbell image works.
Yeah.
And the Bill Gates example at early Microsoft.
Yeah, always insisting on having enough cash to cover a year's payroll, even with zero revenue coming in.
Proactive paranoia.
And what's interesting there is cash. People see it as low return, unproductive.
Dead money sometimes.
But its indirect return can be huge. It prevents you from being forced to sell stocks or other assets when they're down cheap during a crisis.
Right. That flexibility, the ability to ride out a storm without desperate moves, that's incredibly valuable. Way more than a few points of interest on the cash.
Okay, so planning for the unexpected is key. Now let's dig into something really interesting. Aiming to be just pretty reasonable with money, instead of striving for cold, hard rationality.
This feels counterintuitive sometimes.
It does, because traditional finance often focuses on the mathematically optimal strategy. But the book argues, very smartly I think, that people don't always want optimal if it stresses them out.
They want something they can stick with, something that lets them sleep at night.
Exactly. That's often far more effective long term. The book uses that history of fever treatment.
Oh yeah, that was fascinating.
For ages, fevers were feared, fought against. Then science learns, hey, fevers help fight infection.
Right.
So the rational next step in the early 1900s, injecting people with diseases to cause high fevers to fight other infections.
Sounds insane now.
Totally. Because that rational approach ignored the risks, the suffering, the human element. It shows how pure logic, divorced from real-world messiness and human behavior, can be really flawed.
And that's so relevant to finance, an optimal strategy on paper, maybe using lots of leverage.
Looks great in a vacuum.
But if it makes you constantly anxious, ready to panic sell at the first dip, it's unreasonable, unsustainable for most people.
So the insight is, aim for pretty reasonable. Make choices you can live with long-term that align with your emotional tolerance. That's often better than chasing pure rationality that you can't stick with. The book even talks about loving your investments, not because they're guaranteed winners, but because that connection gives you resilience in tough times. Find a strategy you can stay loyal to.
Okay, this brings us to forecasting, the illusion of certainty. We all want to know the future, especially with money.
But the book makes a strong case. Consistently predicting the economy or the market, it's incredibly hard, maybe impossible.
We lean so heavily on history, don't we? Like it's a perfect map.
We do. And history gives context, for sure. But the future is rarely just a repeat. Think about huge structural changes. The 401k, venture capital, these are relatively new things.
So past data only goes so far.
Right. And then there's just the sheer unpredictability of human behavior. Collective psychology can derail any model.
Which is where long tails come in, these rare, unexpected events that have a massive impact.
Exactly. Our biggest outcomes, good and bad, are probably driven by a small number of these long tail events. Think of the major market crashes or the rise of giant tech companies.
No one consistently predicted those.
Very few, if any. They're hard, maybe impossible to foresee reliably, yet they reshape everything. The book uses that simple example. Some are just investing a set amount every month, month after month, no matter what.
Boring, almost.
Seemingly average behavior. But it lets them ride out the volatility and ultimately benefit from those unpredictable, powerful, long-term gains, those long tails.
So the real investing genius, maybe, isn't the predictor. It's the person who stays calm and does average things when everyone else is freaking out.
Well put. Now let's talk about the price of investing. It's not just money. There's an emotional cost, too.
Right. Volatility, the ups and downs, the book argues it's not a fine you pay for doing something wrong.
No.
It's the price of admission. Like buying a ticket to Disneyland. You pay to get in, hoping for the rewards inside.
Great analogy. You don't expect the rides for free. You shouldn't expect market returns without experiencing some volatility.
And trying to dodge that price, trying to avoid volatility completely, that often backfires.
Hugely. Market timers jumping in and out, they often underperform people who just buy and hold. They miss the best days, get whipsawed by emotions.
Yeah, the stress alone.
Exactly. Which connects to this distinction between being rich and being wealthy.
Okay, explain that.
Rich is often visible.
Yeah.
High income, fancy car, big house, it's what you spend. Wealth is often invisible. It's the money you didn't spend, the assets you accumulated quietly, the car you didn't buy, the upgrade you skipped.
So wealth is about security, options, freedom.
Exactly. True wealth is what you don't see, and the key to building it.
Saving.
Saving. The book says saving is the gap between your ego and your income. Resisting the urge to show off, prioritizing security instead. Humility becomes a financial superpower.
That idea of security and options flows right into the next point. The incredible return you get from controlling your time.
This might be the biggest, yet most overlooked, benefit of financial well-being. The power to control your schedule, to say no to a job you hate, to take time off, to pursue passions without desperate financial pressure. That autonomy, it's priceless, truly.
And in today's world, always connected, always on, control over your time feels even more valuable.
It's a scarce currency. The author mentions his early internship in investment banking.
Right, the crazy hours.
Huge pay, yes, but at the cost of nearly all personal time, freedom, control. He realized the trade-off wasn't worth it for him.
It really highlights those trade-offs. Chasing the highest income might actually make you less happy if it costs you all your freedom.
Exactly. So the book suggests aiming for pretty reasonable goals across different parts of your life. Savings, free time, family time. Don't push one area to an extreme that creates imbalance and regret.
And be willing to change course.
Crucially, abandon old goals if they don't fit who you are now. No sunk costs when it comes to your well-being.
Okay, let's touch on the messiness of reality. It's easy to judge financial decisions from afar, right?
Much easier. Actually being in the thick of it is way harder.
The GE example, the rise and fall. Looking back, it's easy to point fingers.
But the leaders making those calls were dealing with immense complexity, pressures, things we can't see from the outside.
It just shows investing has a price beyond money. Volatility, fear, doubt, uncertainty.
You have to be willing to pay that psychological price to get the potential rewards. Trying to get returns without that rarely works long-term.
And it's so easy to take cues from people playing a totally different game.
Oh, yeah. Different goals, different timelines.
Like the dot-com bubble. Short-term traders chasing momentum. Long-term investors getting sucked into valuations that made zero sense for them.
Precisely. You have to know your own game. Your goals, your risk tolerance, your timeline. Filter out the noise from people playing differently.
Okay, let's talk about pessimism. Why does bad news seem so much louder in finance?
The book nails this. Pessimism is just more persuasive, more attention-grabbing.
Why, though?
Well, money affects everyone, so bad financial news gets clicks, gets attention. And psychologically, stories about decline, disaster, loss, they just seem more compelling, easier to create, easier to remember than slow, steady progress.
So true. Predict a crash and you get headlines. Predict steady growth. Crickets.
And pessimists often just extrapolate today's bad trend forever without factoring in adaptation, innovation. Remember all the peak oil predictions?
Yeah, they never quite happen.
Because markets and people adapt. Progress is often slow, incremental, almost invisible day to day. Setbacks are fast, dramatic, loud, so we overweight the bad stuff.
Even if the long-term trend is up.
Right. Which leads to our last main point, the power of stories and how fragile those financial narratives can be.
We're wired for stories.
Deeply. And we often want things to be true. So we latch on to compelling stories, even if they overestimate the odds. And since none of us see the whole picture, we create narratives to fill the gaps. Tidy stories from incomplete information.
Which can lead to big misunderstandings in markets. Bubbles.
Exactly. And we tend to overestimate how much control we actually have. We credit skill for luck, downplay randomness.
It's like we all have our own little economic theory based on our limited view.
And we assume it applies to everyone. So we follow others without really knowing their story, their goals, their risk tolerance. It can lead you way off course for your own situation.
Okay, so we've covered a lot. Maybe this is a good spot for us to share some personal takeaways. what really resonated.
Yeah, good idea.
For me, diving back into this stuff really hammers home the need to be aware of my own emotional triggers with money. Like, recognizing when fear or greed is creeping in, that feels like half the battle. And that idea of defining enough for myself, not based on comparisons, that's been huge for focusing on what actually matters, like independence, control over time.
Yeah, for me, it's that constant humbling reminder about luck and risk, just how big a role they play.
Right.
Acknowledging that uncertainty makes me focus more on resilience, on building a solid foundation, rather than chasing maybe unsustainable highs. And also that idea of aiming for reasonableness over pure cold rationality.
The sleep at night factor.
Exactly. Finding a path that works for my long-term goals and my peace of mind right now. That feels much more sustainable.
So, quick recap of the big themes. Understanding your own psychology is key. Acknowledge luck and risk. Harness compounding through time. Build in a margin of error. Aim for reasonable, not perfectly rational, accept the price of investing.
And ultimately, manage money in a way that lets you sleep well, reduces stress, and helps you define success on your terms, like that independence you mentioned.
Definitely. Now, before we wrap, the book has that really interesting postscript about the U.S. consumer mindset, some historical context.
Oh yeah, that's fascinating. It starts post-World War II. You had all this pent-up demand,
Right.
plus rising productivity, and crucially, the deliberate creation of the American consumer through easier credit, lower rates.
Building the suburbs, buying cars.
Exactly. And for a while, the economic gains were pretty widely shared. People across income levels felt like they were getting ahead.
So that created these deep expectations, right, of a prosperous middle class, a similar standard of living for many.
Deeply ingrained expectations. But then things started changing in the 70s. Growth continued, but it became much more unevenly distributed.
Yet those post-war expectations didn't really change.
They largely persisted. So median wages started stagnating for a lot of people, but houses got bigger, car loans got bigger, college costs exploded.
And debt filled the gap.
Household debt soared. People trying to maintain a lifestyle that income alone couldn't support anymore.
Trying to keep up with those lingering expectations.
Exactly. That disconnect expectations versus economic reality fueled the rise in debt, increased vulnerability, and arguably contributed to the 2008 crisis.
And even though there's been some deleveraging since, that underlying tension is still there.
It really shapes the psychology of the U.S. consumer today, fuels frustrations, maybe even some political movements. Understanding that history is pretty crucial for grasping the current mindset about money here.
So bringing this all home, the main point is clear. Understanding the psychology of money your own and the broader forces, it's critical. Often overlooked, but absolutely vital for long-term financial well-being.
Couldn't agree more. And maybe a final thought for you listening. Take a moment. Pick one financial belief you hold. Just one. And really think, how did your personal history, your experiences, shape that belief? And then, the big question, does that belief still serve you well today in this economy? Is it helping you or maybe holding you back?
That's a great prompt, something to really chew on. Thanks so much for taking this deep dive into the psychology of money with us today.
Yeah, hope it sparks some useful thoughts for your own financial journey.